Last Tuesday, a 28-year-old trader lost $43,000 in 4 minutes. Not because the market crashed, not because of bad news, but because of 3 words he whispered to himself, just this once. Those 3 words have killed more trading accounts than every market crash combined. He moved his stop loss, just this once. He doubled his position, just this once. He ignored his rules, just this once. 4 minutes later, his 5 years of savings were gone, liquidated, vaporized, and the sickest part, the market reversed 30 minutes later, exactly where his original stop loss would have saved him. This isn't rare. This is Tuesday in trading. You see, they teach you how to predict price, how to read charts, how to find setups, but no one teaches you how to not die. You spend months mastering indicators, yet 0 seconds mastering the most important skill of all, staying alive long enough to learn from your mistakes. Because here's the truth that will haunt you. 90% of traders lose money in their first year, but not for the reason you think. It's not because they can't find good trades, it's because they can't survive their bad ones. Welcome to Trading Psychology Stick. This isn't financial advice, it's survival wisdom from someone who's bled in these markets. What you do with it determines whether you join the 90% who disappear or the 10% who endure. Grab something to write with. You'll need it, because in the next hour I'm going to show you exactly how traders kill themselves, and exactly how to build the shield that keeps you alive. This is the shield, the difference between those who last and those who become cautionary tales in trading forums. Let's begin with the lie you've been told. Chapter 1. You're not losing for the reason you think. You think you're losing because your system is flawed, because your indicator lagged, because the news shocked the market. But I'm about to show you something that will flip everything you believe about trading losses. Pull up your last 10 losing trades. I'll wait. Now, answer honestly. How many of those losses followed your original plan exactly? How many hit your predetermined stop at your calculated position size? If you're like most traders, the answer is less than 3. Because the ugly truth is this. You're not losing because your analysis is wrong. You're losing because you can't follow your own rules when money is on the line. There's a scene that plays out 100,000 times a day across the world. A trader stares at a screen. Clean setup, perfect entry, stop loss placed. Then the candle turns red. Just a little. The breathing changes. The cursor hovers over the stop loss order. A voice whispers, "Give it room." And right there, in that split second, the trader dies. Not immediately. But that's the moment the end begins. I call it the 3-stage death spiral, and once you see it, you can't unsee it. Stage 1, the negotiation. Maybe I'll just move the stop down 20 pips. The market always stops me out right before reversing. Stage 2, the justification. Actually, this is an even better entry. I should add to my position, lower my average. Stage 3, the desperation. I can't close now. I'm down too much. It has to come back. It never comes back. Well, sometimes it does, right after you finally capitulate at the absolute bottom. Let me share what this looks like with real numbers. A trader I mentored, let's call him Marcus, had a $5,000 account. His plan was bulletproof. Risk 2% per trade. That's $100. Simple, clean, survivable. First trade, stop hit, minus $100. Second trade, stop hit, minus $100. Third trade. This is where his brain broke. The setup looked perfect, too perfect. When it went against him, instead of taking another $100 loss, he removed the stop. The market's just hunting stops, he told himself. Then he added to the position. Then added again. When he finally closed it, he'd lost 1,147s, one trade, 37% of his account. Gone. Not because the market was evil, because he couldn't handle being wrong 3 times in a row. His ego needed a win more than his account needed protection. Want to know the sickest part? His original analysis was right. The market did reverse. But by then, he was too damaged, financially and emotionally, to take advantage of it. Quick test. And be honest, have you ever moved a stop loss after entering a trade? Added to a losing position without planning to? Held past your exit because you felt it would reverse? If you answered yes to any of these, comment shield below. Not because I need engagement, but because admitting it is the first step to fixing it. Here's what nobody wants to admit. Trading success isn't about finding better setups. It's about executing the setups you have without sabotaging yourself. The market doesn't beat traders. Traders beat traders. Think about that. Really think about it. Every blown account started with a broken rule. Every broken rule started with an emotion. Every emotion started with a belief that this time is different. But it's never different. The market doesn't care about your mortgage. Doesn't care that you've been right 5 times in a row. Doesn't care that you really need this trade to work. You know what the market does respect? Discipline, consistency. The trader who takes the same stop loss 20 times without flinching. Because that trader will be around to catch the 10 winners that pay for everything. But discipline alone isn't enough if you're fighting on the wrong battlefield. Because Forex and crypto aren't just different markets, they're different worlds. And using the wrong strategy in the wrong world is like bringing a knife to a nuclear war. Let me show you what I mean. Chapter 2. The two battlefields, Forex versus crypto. Imagine walking into what you think is a boxing ring, following all the boxing rules, then realizing your opponent has a chainsaw. That's what happens when traders use Forex strategies in crypto, or crypto strategies in Forex. Same account, same charts, completely different ways to die. I learned this the expensive way. 5 years profitable in Forex, consistent 20 to 30% annual returns. Then crypto happened. How different can it be? I thought. Currency is currency. My first Bitcoin trade, position size calculated perfectly for a 50 pip stop in Forex. Bitcoin moved 3% in 4 minutes. My small position became a massive loss, not 50 pips. 3% in 4 minutes. I'd brought a tennis racket to a gladiator arena. Let's get brutally specific about these battlefields. Forex, the chess game with grenades. Forex is institutional, regulated, it moves in rhythms. London session pumps, New York session dumps. Interest rate decisions create explosions. But even the explosions follow patterns. A 100 pip day in EUR/USD is significant. A 200 pip day is chaos. The market has depth, real volume. When you place $1 million order, the market yawns. It's built for size. But here's the trap. Forex offers leverage like candy. 51, 101. Some brokers offer 501. They're not being generous. They're setting traps. Because a 100 pip move with 500.1 leverage doesn't just hurt. It evaporates accounts instantly. Quick reality check. Write down the highest leverage you've ever used. Now, calculate what a 1% move against you would do at that leverage. Scary? It should be. Crypto. The 24/7 insane asylum. Now crypto. Sweet, volatile, mentally unstable crypto. No closing bell, no weekends, no market hours to rest and reset. It trades while you sleep, while you eat, while you argue with your spouse about spending too much time looking at charts. A 10% daily move in Bitcoin? That's Tuesday. I've watched Ethereum drop 40% in 6 hours, then recover 25% in the next 2. Try putting a stop loss in that. It's like trying to nail Jell-O to a wall. And the players are different. In Forex, you're trading against banks, funds, algorithms designed by PhDs. In crypto, you're trading against degens with life savings on 100x leverage, whales who move markets for entertainment, bots that front-run your orders, exchanges that hunt your stops, protocols that can literally disappear overnight. I once watched a trader apply textbook Forex risk management to crypto. 2% risk, tight stops, clean setups. Lost 60% in a month. Not because his analysis was wrong, because crypto doesn't respect Forex rules. The stops got hunted every single time. Those sudden wicks that appear and vanish in seconds, they're not accidents. They're designed to take your money. In Forex, a stop 50 pips away is usually safe. In crypto, a stop 5% away is appetizer for the whale who's hunting. But here's what most traders miss. Both markets can make you rich. Both markets can destroy you. The difference isn't the market, it's your approach. Think of it like this. Forex equals sniper rifle, precise, calculated, one shot, one kill. Crypto equals machine gun. Spray and pray won't work, but you need more ammunition. In Forex, you can risk 2% with a 50 pip stop and sleep soundly. In crypto, you need to Either reduce position size by 70 to 80%, or widen stops to avoid the hunt, or accept that you'll get stopped out more often. There's no right answer, only the answer that keeps you alive. Pop quiz. If you're trading both markets, what percentage of your total capital is in crypto versus Forex? If it's more than 50% in crypto and you're using leverage, you're not diversified. You're playing Russian roulette with extra bullets. Here's my survival split. 60% Forex for steady income, 30% crypto for growth potential, 10% cash for opportunities and sanity. Adjust based on your risk tolerance, but never put everything in one battlefield, because the moment you do, that's the battlefield that catches fire. The real enemy, though, isn't in either market. The real enemy has been with you all along. It knows your every weakness. It whispers your fears. It amplifies your greed. The real enemy is sitting between your ears, and it's about to get very, very personal. Chapter 3. The Mind. Your most dangerous enemy. I want you to do something uncomfortable. Think about your worst trading loss. Not the size, the feeling. That moment when you realized it was over. The sick drop in your stomach. The heat in your face. The urge to either scream or go completely numb. Now answer this. In that moment, who was your enemy? The market? The broker? The whale who hunted your stop? No, your enemy was the 6 inches between your ears. And until you declare war on that enemy, every strategy you learn is just another way to lose money with extra steps. Your mind is a sabotage machine. It's not trying to hurt you. It's trying to protect you. But the mechanisms that keep you safe in normal life will kill you in trading. Let me show you how. The 4 horsemen of trading psychology. 1. FOMO, the seductive killer. Your brain sees others making money and screams, "You're being left behind." It floods you with cortisol. Your breathing shortens. Your vision narrows. Suddenly, every price movement looks like the last train to Profit City. I once watched a trader friend see a coin pump 50%. He messaged me, "Getting in now." I asked about his analysis. "What analysis? It's going to the moon." He bought the top, down 70% in 3 days. FOMO doesn't whisper, it screams. And it's always wrong at the worst possible moment. Revenge trading, the account assassin. You just lost. The market took your money, made you look stupid, feel small. Your primitive brain activates, get it back, now. You double position size, abandon your strategy, trade like a wounded animal. True story. I once lost $500 on a clean trade. Good setup, just didn't work. Instead of walking away, I tried to make it back. 6 trades later, I was down $3,000. Not because the market was against me, because I was against me. Hope, the slow poison. It'll come back. The 4 most expensive words in trading. Your position is red, stop loss approaching. But instead of accepting the small loss, you remove the stop. Add to the position. Pray to whatever deity might be listening. Hope in life is beautiful. Hope in trading is bankruptcy in slow motion. The market doesn't care about your hope. It only respects your discipline. Greed, the profit killer. The trade is up 2R. Your plan says exit. But that voice whispers, look at that momentum. This could be a 10R trade. So you hold, and watch your profit become a loss. Again, here's the sick truth. Greed has stolen more money from traders than bad entries ever have. Because greed makes you hold winners until they become losers. Write this down. Seriously, pause and write it. The market is not my enemy. My untrained mind is my enemy. Now let's get practical. Here's how you train your mind like a weapon instead of letting it remain a weakness. The 5-minute morning reset. Before you even look at a chart, sit quietly and ask, what am I feeling about trading today? What losses am I still carrying? What wins am I overconfident about? Am I trading to make money or to feel something? That last question will save you more than any indicator ever will. The mid-trade reality check. When you're in a position and feel the urge to break your rules, ask, what would I tell someone else to do right now? Am I trading my plan or my emotions? Will I be proud of this decision tomorrow? If you can't answer cleanly, close the trade. Flat is better than stupid. The post-trade autopsy. After every trade, win or lose, document what you planned, what you actually did, what emotion drove any deviation, what you'll do differently next time. This isn't journaling, it's pattern recognition. After 20 trades, you'll see your psychological patterns like a map of your weaknesses. But here's what nobody talks about. Your mind isn't just sabotaging your trades, it's sabotaging your entire approach to risk. Because most traders think risk management is about math. It's not. It's about building a fortress so strong that even when your mind betrays you, and it will, your account survives. Comment mindset. If you've ever broken your own trading rules and immediately regretted it, because recognizing the pattern is the first step to breaking it. And once you see the pattern, you're ready for the numbers that will save your trading life. Chapter 4. The Complete Risk Formula. Your Mathematical Shield. I'm about to show you 4 numbers that determine whether you'll be trading in 5 years or telling stories about how you used to trade. These aren't sexy numbers. They won't make you rich overnight, but they'll keep you alive long enough to get rich slowly. And here's the thing. Everyone knows these concepts. Position size, leverage, stop loss, take profit. But almost nobody understands how they work together. It's like knowing you need wheels, engine, brakes, and steering to drive, but not understanding that without one, the others are useless. Let me tell you about James. Brilliant trader, could predict market moves like he had tomorrow's newspaper. His win rate, 73%. Impressive, right? He's broke now, lost everything in 1 week, not because his analysis failed, because he never learned that these 4 elements multiply each other. He thought 2% risk meant 2% risk, but with 50x leverage and a tight stop, his 2% risk was actually 100% exposure, 2% move against him, which happens every single day in crypto, and his account went to 0. He had all the pieces. He just never learned how to connect them. So, let's connect them. Forever. Starting with position size. Your foundation of survival. Position size is like oxygen. Get it wrong, and nothing else matters. You'll be dead before your strategy has a chance to work. Here's the formula that should be tattooed on your trading hand. Position size equals account balance x risk percent, and stop distance x leverage factor. Let's make this real. You have $10,000. You want to risk 1%, 100. Your stop is 50 points away. You're using 10x leverage. Position size equals 100. 50 x 10 equals 0 points, hold is 20 per point. Tiny? Yes. Boring? Absolutely. Still trading in 5 years? Probably. But watch what happens when ego enters. Same setup, but you think, this setup is perfect. Let me risk 5%. Now you're risking 500. Same 50-point stop. Your position is now $1 per point. Market moves 100 points against you, normal Tuesday, and you've lost 10% of your account. 3 of those, and you're down 30%. Welcome to the death spiral. Write this down. Position size is not about the trade. It's about the next 100 trades. Leverage, the multiplier. Most traders multiply. Wrong. Every week, I see the same post in trading groups. Just lost everything on one trade. I don't understand. I only risked 2%. Then you dig deeper. They were using 50x leverage. Their 2% risk was actually 100% exposure. The exchange liquidated them before their stop even had a chance to trigger. Here's how leverage really works. It multiplies everything. Your gains, your losses, your emotions, your mistakes. Everything. Think of leverage like alcohol. 1 drink, you're more social. 10 drinks, you're face down making decisions you'll regret forever. The problem isn't the alcohol, it's your relationship with it. My leverage rules that have kept me alive. Forex, maximum 10.1, usually 5.1. Crypto, maximum 5.1, usually 2.1. When volatile, no leverage at all. But that's so conservative. Yes, that's why I'm still here. Quick gut check. Take your last losing trade. Now multiply that loss by your leverage. If that number makes you sick, your leverage is too high. Period. Stop loss, your ejection. Seat when everything goes wrong. Every building has fire exits. Every car has brakes. Every plane has ejection seats. But traders, they enter positions like they're immortal. Your stop loss is not your enemy. It's your best friend saving you from yourself. But most traders place stops wrong. They pick round numbers. They put them at obvious levels. They place them based on hope, not structure. Here's how to place stops that actually protect you. In Forex, look left. Where did price bounce before? Put your stop beyond that level, not at it. Add 10-20 pips buffer. Yes, it means smaller position size. That's the point. In crypto, whatever stop distance you think you need, multiply by 1.5. Crypto hunt stops like a predator. That perfect stop at 5% below entry, it's where everyone else put their stop too. Make it 7-8%. Give the chaos room to breathe. But here's the master key. Your stop loss should hurt, but not cripple. If hitting your stop makes you emotional, your position is too big. If hitting your stop makes you quit trading, your risk is too high. Take profit, the forgotten discipline that separates survivors from statistics. Most traders obsess over entries and forget exits, like planning the perfect wedding but forgetting the honeymoon. Then they watch profit turn to loss and wonder what went wrong. Taking profit isn't about perfection. It's about consistency. You will never, never sell the exact top. Stop trying. Start surviving. My profit-taking system that actually works. First target, 1.5R, risk reward. Take 50% off, move stop to break even. Second target, 3R. Take another 25% off. Let final 25% run with trailing stop. Is it perfect? No. Do I leave money on the table? Always. Do I sleep peacefully? Every night. The integration, making these 4 elements. One system. Here's where magic happens. These aren't 4 separate concepts. They're one integrated formula for survival. If you have $10,000 and risk 1% per trade, $100. With 50-point stop and no leverage, $2 per point position. With 50-point stop and 10x leverage, $0.20 per point position. With 100-point stop and 5x leverage, $0.20 per point position. Same risk, completely different positions. This is how you adjust for different markets, different volatility, different conditions. The risk stays constant. Everything else adapts. Take 30 seconds right now. Calculate your position size for your next trade using this formula. If you've been trading without doing this calculation first, you've been gambling, not trading. But individual trades are just battles. To win the war, you need something bigger. You need a fortress that protects your entire trading empire. And that fortress, it's built with 2 materials most traders think are too advanced for them: diversification and automation. They're not advanced. They're essential. Let me show you why. Chapter 5. Building your fortress, diversification and intelligent automation. At 3:47 a.m. on November 11th, 2022, FTX, the safest crypto exchange, froze withdrawals. By morning, $32 billion was gone. Traders who had everything there lost everything. Period. No appeals, no recovery, just silence where their life savings used to be. But here's the thing. Some traders lost 100%, others lost 15%, same event. Completely different outcomes. The difference? The survivors had built fortresses, not houses of cards. I'm about to show you how to build a trading fortress so robust that even when disasters hit, and they will, you don't just survive, you barely notice. The 3 layers of true diversification. Most traders think diversification means owning different coins. That's not diversification, that's collection. When Bitcoin dumps, your altcoins dump harder. You're not diversified, you're concentrated with extra steps. Real diversification has layers. Layer 1, asset diversification. This isn't about owning 50 different assets. It's about owning assets that move differently. My allocation that survived every crash. 30% major Forex pairs. EUR/USD, GBP/USD, the stable income. 30% crypto blue chips, BTC, ETH, the growth engine. 30% stablecoins, the dry powder. 10% cash in bank, the sleep at night money. When crypto crashes 40%, Forex might be flat. When Forex is choppy, crypto might be trending. When everything correlates, cash is king. Quick check. Pull up your portfolio right now. If any single asset is more than 40% of your total capital, you're not diversified, you're exposed. Fix it this week. Layer 2, platform diversification. Never more than 33% on any exchange. Ever. I don't care how safe it seems. MintGox was safe. Quadriga CX was safe. FTX was the safest, until they weren't. My setup. Exchange A, 30% for active trading. Exchange B, 30% for different strategies. Cold wallet, 30% for long-term holdings. Traditional broker, 10% for Forex stocks. Yes, it's inconvenient. Yes, it costs more in fees. Yes, it's why I still have money when others don't. Layer 3. Strategy diversification. One strategy is like having one road to work. When that road closes, you're stuck. Multiple strategies mean multiple ways to profit. My strategy mix, trend following, works in strong moves. Mean reversion works in ranges. DCA accumulation works in all markets. Yield farming, passive income regardless of price. Different strategies for different seasons. Because markets have seasons, and traders who only know summer freeze in winter. Write Fortress below if you currently have more than 50% of your capital in one place. No judgment, just awareness. Because awareness is the first step to protection. The robot revolution. Automation that protects instead of destroys. Now, let's talk about the machines. Most traders fear automation. They imagine complex algorithms, coding nightmares, bots that drain accounts while they sleep. But modern automation isn't about replacing you. It's about protecting you from yourself. Let me tell you about Sarah, terrible trader, emotional, impulsive, revenge traded constantly, lost 70% in her first year. Then she discovered automation, not complex bots, simple systems that removed emotion from the equation. 2 years later, she's up 140%. Same person, same knowledge, different execution. Here's what automation really looks like. The DCA bot, your emotional stabilizer. Every Monday at 9 a.m., a bot buys $500 of Bitcoin. Up, down, sideways. Doesn't matter. No emotion, no timing, no waiting for the dip. Over 2 years, this brainless bot has outperformed my smart manual entries by 35%. Why? Because it never panic sells, never FOMO buys, never revenge trades. It just executes. Boring, profitable, peaceful. The grid bot, farming volatility without prediction. In ranging markets, grid bots place buy orders below price and sell orders above. Price goes down, it buys. Price goes up, it sells. No prediction required, just systematic profit from volatility. I run a grid bot on ETH USDT with 3% grid spacing. Monthly return, 2 to 5%, not life-changing. But it compounds, and it works while I sleep, while I eat, while I live my life. The stop loss. Bot, your discipline enforcer. The simplest but most powerful automation. A bot that places stop losses immediately after entry. Non-negotiable, non-removable. It doesn't care about your feelings. It just protects. True story. I once coded a bot that literally locked me out of modifying stops for 24 hours after placing them. Best trading decision I ever made. Remove the temptation entirely. The integration rules that keep automation. Safe. Never automate with money you're not willing to lose. Start with 5% of capital. Let it prove itself before scaling. Monitor weekly, not daily. Daily monitoring leads to meddling. Weekly gives perspective. Have a kill switch. Maximum 20% drawdown, and the bot dies. No exceptions. No, just a little longer. Keep automated funds separate from manual funds. Different games, different rules. Never mix mid-session. Test every bot on demo for minimum 30 days. If it can't profit on demo, it won't profit on real money. Review and adjust monthly. Markets evolve. Bots don't. You must bridge that gap. The hidden power of fortress thinking. Here's what changes when you build a proper fortress. You stop trading scared. When your capital is spread across multiple assets, platforms, and strategies, no single loss can kill you. You trade with clarity instead of desperation. Last month, one of my exchanges went down for maintenance. 3 years ago, that would have stressed me out. Now, I barely noticed. My other accounts kept trading. My bots kept running. My fortress kept standing. But fortresses aren't built in a day. And the best time to build one isn't during a crisis. It's right now, when everything seems fine. Your homework. This week, open one new account. Move 25% of your capital there. Set up one simple DCA bot. Start small, start simple, but start. Because the traders who survive aren't the ones who predicted the crisis. They're the ones who prepared for any crisis. Speaking of crises, let's look at the bloodbaths of the past and the storms approaching. Because those who don't learn from history aren't just doomed to repeat it, they're doomed to fund it with their accounts. Chapter 6. Lessons from the Battlefield, Past, Present, and Future. Every year, a new group of traders discovers the market. They bring fresh accounts, bright dreams, and the absolute certainty that they're different, smarter, more disciplined, better informed. They've watched the YouTube videos, read the books. They know about risk management. 6 months later, 90% are gone, their accounts drained, their confidence shattered, their names added to the endless list of the forgotten. But between the legends and the casualties, there are ghosts. Traders who survived disasters that should have killed them, who learned lessons written in red ink, who built systems from scar tissue. Today, you meet them, not to worship, not to copy, but to understand the difference between those who last and those who become liquidity. The gods and the graves. Let's start with the legends, the ones everyone knows. George Soros, 1992, bet against the Bank of England, made $1 billion in a day. But here's what the course sellers don't tell you. Soros was prepared to lose. His position was massive but calculated. He famously said, "It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong." Paul Tudor Jones, 1987, Black Monday. Markets crashed 22% in one day. Jones made 60% profit. How? He wasn't predicting, he was protecting. He traded with the assumption that crashes were possible. So, when the impossible happened, he was ready. His secret? I think I am the single most conservative investor on earth. The man who made millions in a crash called himself conservative. Let that sink in. Now the graveyards, the warnings, the whispers of what not to do. Long-term capital management, the smartest guys in every room, Nobel Prize winners, PhDs, quants. They built models that couldn't lose. Leverage, 25-1. When Russia defaulted in 1998, their impossible scenario happened. $4 billion. Gone. The lesson? Intelligence plus arrogance equals explosive destruction. More recently, Three Arrows Capital, the crypto darlings, Suju and Kyle Davies, managed $18 billion at the peak, seen as geniuses, untouchable, infallible. Then Luna collapsed, leverage unwound, margin calls cascaded. Within weeks, $18 billion became $3 billion in debt. The founders vanished, investors left with nothing. The lesson? No bull run lasts forever, but leverage makes you act like it will. But here's the pattern everyone misses. Every spectacular failure started with spectacular success. They got confident, they got large, they got leveraged, they got liquidated. The silent survivors. Between legends and casualties are the traders you've never heard of. They don't sell courses, don't post screenshots, don't have Twitter followers. They just quietly compound wealth, year after year, decade after decade. I know a Forex trader, let's call her Maria, trading since 2008. Never had a year over 35% returns. Also never had a year with more than 12% drawdown. Her secret? She risks 0.5% per trade, takes profits at 1.5 R, misses every moonshot, survives every crash. "I'm not trying to get rich this year," she told me. "I'm trying to be trading in 20 years. Another ghost, David. Crypto class of 2013. Watched Bitcoin go from $100 to $20,000. Also watched it crash to $3,000. Still trading, still profitable. His rule? Every time an asset doubles, he sells 25%. He's left millions on the table. He's also never been wiped out. Everyone remembers who bought the bottom, he says. Nobody remembers who survived the top. Comment survivor if you'd rather be trading in 10 years than rich in 10 months. Because that mindset shift is worth more than any strategy. The future storm approaching. But surviving the past doesn't guarantee surviving the future, because the battlefield is evolving faster than most traders can adapt. AI isn't coming, it's already here. While you're drawing trend lines, AI systems process millions of data points, scan sentiment across languages, execute trades in microseconds. It's not human versus machine anymore. It's human with machine versus human without. Last month, a hedge fund's AI caught a correlation between Korean social media sentiment and Bitcoin price movement. They front-ran the market by 4 hours, made 12% in a day. The traders drawing triangles never saw it coming. Central bank digital currencies will change everything. Programmable money, traceable transactions, expiring currency. Imagine Forex trading when governments can freeze cross-border flows instantly, when your profits are auto-taxed before withdrawal, when your trading ability depends on your compliance score. China's already testing, Europe's following, the US won't be far behind. This isn't conspiracy, it's on their websites. Regulatory avalanches are building. Every month, new rules, new restrictions, new requirements. Exchanges that were legal yesterday are banned today. Strategies that worked last year are illegal this year. The survivors won't be the ones who fought change. They'll be the ones who adapted faster than regulation could restrict. The integration lesson. So, what do the gods, the graves, and the ghosts teach us? Simple. The next disaster won't look like the last one, but it will still reward preparation and punish arrogance. Your edge isn't predicting which crisis comes next. It's building systems that survive any crisis. Position sizing that assumes you're wrong, diversification that assumes platforms fail, automation that assumes emotions betray, capital preservation that assumes black swans are white. Every legend was once a beginner who refused to quit. Every ghost was once a winner who forgot to defend. Every grave was once a genius who thought they had transcended risk. Which story are you writing? The market doesn't care about your potential. It only respects your preparation. And preparation without action is just sophisticated procrastination. It's time to stop learning and start building. Your 90-day transformation starts now. Chapter 7. The 90-Day Action Plan. Building your shield, one day at a time. In 90 days, you'll either be a completely different trader or you'll be telling the same story with a smaller account. The difference isn't knowledge. You already have that. The difference is execution. Daily. Boring, relentless execution. This isn't a plan for perfection. It's a plan for progress, not a sprint to riches, a march to resilience. Because resilience compounds, and compounding is how poor traders become wealthy ones. But first, let's get real. If you're looking for the make 1,000% in 90 days plan, close this video. Go buy a lottery ticket. It's more honest. This plan is for traders who want to be here in 10 years, not YouTube screenshots. Ready? Let's build your shield. Phase 1. Days. 1:14. Know your enemy. Spoiler, it's you. For 2 weeks, you're not allowed to trade. At all. 0. Not even demo. Your only job is reconnaissance. You're mapping the enemy, and the enemy is your own psychology. The emotion journal. Every morning, write, how do I feel about not trading today? Anxious, relieved, bored, document it. Every afternoon, what trading thoughts appeared? Did you check charts? Feel FOMO? Want to just take one trade? Every evening, what patterns am I noticing? Are you obsessed, addicted, desperate? Be honest. This isn't therapy, it's intelligence gathering. By day 14, you'll have a clear map of your psychological triggers, the urges, the patterns, the weaknesses. Write them all down. The brutal questions. At the end of week 2, answer these. Why do I really want to trade? Money? Excitement? Proving something? What am I running from? Boredom? Current job? Feeling unsuccessful? What would happen if I never traded again? Really think about this. If you can't handle 2 weeks without trading, you're not a trader, you're an addict. And addicts don't make money in markets, they donate it. Comment ready if you're willing to go 14 days without placing a single trade to build your foundation. Because if you can't do this, nothing else matters. Phase 2, days, 15 to 30. One setup, one market, pure discipline. Now you trade, but with military discipline. The rules: one trading pair only. EUR USD or BTC USD, not both. One strategy only. Support resistance. Moving average cross. Pick one, master it. 1% risk maximum, non-negotiable. Demo account only. Your ego says that's not real trading. Perfect. We're not training your account yet. We're training your discipline. The process. Every trade requires 1. Written plan. Before entry, I'm entering here because X, stop at Y, target at Z2. Screenshot at entry 3. Emotion. Check, am I calm? If no, don't trade. 4. Screenshot at exit. 5. Review, did I follow my plan exactly? Track everything. Win rate. Average risk reward. How often you followed rules versus broke them. Emotional state during wins and losses. By day 30, you'll have 50 plus trades of data. Patterns will emerge. You'll see exactly when and why you break rules. This awareness is worth more than any indicator. Phase 3. Days. 31:45. Small live trades. Big reality. Check time for real money, but we're still crawling before walking. The funding. Add an amount that would hurt to lose but not change your life. For some, that's $500. For others, $5,000. If you can't afford to lose it, it's too much. The reality rules. Risk 0.5% per trade. Yes, 0.5%. Yes, that's tiny. That's the point. Maximum 3 trades per day. Maximum 1.5% daily loss. Hit it, screen off. Day over. Same setup as demo. No experimenting. What happens here? Real money triggers real emotions. Your perfect demo discipline will wobble. You'll want to increase size, move stops, revenge trade. This is normal. This is the test. Document every urge to break rules. When you want to increase size, write why. When you want to remove a stop, document the excuse. This is your psychology in real time. Phase 4. Days. 46:60. Building the fortress. Your discipline is established. Time to add protection layers. Week 1. Platform diversification. Open account with second broker, split capital, 60/40. Trade same strategy on both. Document any differences in execution. Week 2. Create your trading constitution. Write and print these rules. I will never risk more than 1% per trade. I will never risk more than 3% per day. I will never trade without a stop loss. I will never add to losing positions. I will never trade to make back losses. I will increase size only after 30 profitable trades. I will decrease size immediately after breaking any rule. Sign it, date it, put it where you trade. This is your external discipline when internal discipline fails. Phase 5. Days. 61-75. Strategic expansion only if profitable. If not, repeat phase 3. Choose one expansion, add a second pair, same strategy. Add a second time frame, same pair, same strategy. Add 10% allocation to simple automation, DCA bot. Add a second strategy, same pair. The key, one change. Monitor for 2 weeks. Document impact on psychology and results. Most traders fail here. They get confident. Add too much too fast. Don't be most traders. Phase 6. Days. 76-90. Cementing the system, final phase. Making excellence automatic. Daily checklist. Print and use. Morning emotion. Check, am I trading or am I gambling? Pre-trade checklist. Setup valid. Size calculated. Stop placed. Post-trade review. Plan followed. Lessons learned. Evening review. What worked? What didn't? What's tomorrow's focus? Weekly reviews. Every Sunday. Answer. What patterns helped me? What patterns hurt me? What rules saved me? What would I tell someone else to do differently? The 90-day result. You won't be rich, but you'll be something better, consistent, disciplined, protected. You'll have 100+ trades of personal data, clear psychological patterns identified, proven ability to follow rules, multiple broker accounts, written trading constitution, systematic review process, small but consistent profits, maybe. Most importantly, you'll have evidence, proof that you can follow a plan for 90 days. That discipline alone puts you in the top 10% of all traders. The market rewards patience, it rewards discipline, it rewards those who build strong foundations before reaching for the sky. Your move, 90 days. Starting when? Drop the date you're starting below. Make it public, make it real. Because accountability is the bridge between intention and accomplishment. Your shield awaits, but it's built one day at a time. Will you build it? Or will you join the 90% who are going to start tomorrow until they run out of tomorrows? The choice has always been yours. Now you have the blueprint. What's your excuse? Bring the shield home. You've been sitting here for over an hour. You've seen the corpses, met the survivors, learned the formulas, faced the psychology. You know why traders die and how they live. The question isn't what you know anymore. The question is, what are you going to do in the next 24 hours that your future self will thank you for? Because here's the brutal truth. In 6 months, you'll either be using these principles or you'll be another statistic. Another I used to trade story. Another account that fed the market's endless appetite for the unprepared. But you're different. You watched to the end. That alone separates you from 95% who clicked away after 5 minutes looking for indicator secrets and whale signals. So here's exactly what you do next. The next 24 hours. First hour. Open your trading journal or create one. Write this question at the top. What trading rule have I broken most often? Answer honestly. That's your primary enemy. Name it. Own it. Prepare to fight it. Next 3 hours, calculate your current risk exposure. Every position, every platform, every coin, add it up. If losing it all would change your life, you're overexposed. This weekend, fix it. No excuses. By tonight, make one change. Just one. Maybe it's setting up a second exchange account, calculating position size before your next trade, writing your 1% risk rule and taping it to your monitor. Starting a simple $50 a week Bitcoin DCA documenting your next 10 trades properly. 1. Change. Today. The commitment. Don't comment great video or thanks. Comments without commitment are just noise. Instead, write exactly what you're implementing in the next 24 hours. Make it specific, make it measurable, make it public. Examples. Opening Kraken account tomorrow, moving 40% of crypto there by Sunday. Starting a motion journal tonight, tracking for 14 days. Minimum installing position size calculator, using before every trade starting now. Setting up $100 weekly BTC DCA, starting this Monday. Why public? Because the moment you write it where others can see, you've created accountability. You've joined a brotherhood of traders who choose survival over excitement. The resources. Everything mentioned in this video is organized in one place. Position size calculator, works for Forex and crypto. Emotion journal template, 90-day checkpoint system. Trading constitution, template, platform diversification, checklist, risk assessment, spreadsheet, link below. No email required, no course to buy, just tools from one survivor to another. Because I want you here in 10 years, not gone in 10 months. The reality check. But tools without action are just digital dust. So let me be brutally clear. If you've watched this entire video and do nothing different tomorrow, you've just entertained yourself into poverty. Knowledge without implementation is worse than ignorance. At least the ignorant have an excuse. You don't have an excuse anymore. You have a choice. The challenge. For the next 7 days, before every single trade, ask yourself, am I wearing my shield? Position size properly? Stop loss set? Platform risk diversified? Following my rules? If the answer to any of these is no, don't trade. Period. Flat is better than foolish. The truth. The market is open tomorrow, or in a few hours, or right now, because crypto never sleeps. And when you face that next trade, you'll remember this moment. The moment you had all the information you needed to survive. What you do with that moment determines everything. Your shield isn't built from watching videos. It's built from taking action when every cell in your body wants to chase the next pump. It's built from calculating position size when you just know this trade will work. It's built from taking profits when greed whispers let it run. It's built from doing the boring things that keep you alive, while others do the exciting things that get them killed. The final question. In 1 year, when you look back at today, what story will you tell? That's the day I watched a video about risk management. Or, that's the day I stopped trading naked. That's the day I built my shield. That's the day I chose survival over ego. That's the day everything changed. The market doesn't care about your decision. It'll take your money either way, but your future self cares. Your family cares. Your dreams care. So, what's it going to be? Another video in your watch history? Or the first day of your trading resurrection? Comment your commitment below. Join the Brotherhood of the Shielded. Take the first step. Because the best time to build your shield was before your first trade. The second best time is right now. Welcome to survival. Now prove you deserve it.